Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the markets. Inflation is just through the roof. This is like ridiculous. Look at the consumer price index, CPI. It's up like 11% from 2020. It's a horrible number. It's a horrible number. And this is having a terrible effect on the market because when inflation goes up, interest rates need to go up. And when interest rates go up, that has a cascading effect on everything in the market. What we need to do right now is really position your portfolio in a way where you're able to at least preserve the wealth that you guys have created over the last, 5, 10, 15, 20, 30 years, right? You want to preserve your assets at this point and still grow if possible. So what can you guys do to hedge against inflation? There's certain securities, there's certain sectors that are going to do better than others, right? Tech-oriented companies, growth-oriented stocks aren't going to be doing well in a rising interest rate environment, or at least not as well. And there's a whole bunch of reasons, and I won't bore you guys with the math as to why that's true. But if you're looking for more value-oriented stocks or commodities, those do really well in higher interest rate environments or in an inflationary environment. So I want to go over a couple different stocks that I think are really primed to move forward and at least position a part of your portfolio to hedge against inflation. Subscribe to the channel to get the most up-to-date and relevant information. Also, go along on that like button. Appreciate it. Let's start off with our first company for today. It's Petrobras. Petrobras is a Brazilian company and one of the largest producers of oil and gas in the world, primarily engaged in exploration and production, refining, energy generation, and trading. They have a large proven reserve base and have acquired expertise in deep and ultra-deep water exploration and production as a result of almost 50 years spent developing the Brazilian offshore basins. So Petrobras is it's a great company. It's a pretty decent size too. They're about $84 billion market cap. So a larger organization that we're dealing with here, a company that has a lot of capital and has been putting it to work in some really efficient ways. In the past year, they have a 58, almost 59% return, and year to date, they're doing fantastic with over a 21% return, close to 22% year to date. A lot better than what we're seeing in the S&P and a lot of these growth stocks, that's for sure. They have an earnings per share of $3.37 on a stock price of $13.57, so solid earnings per share. They have a forward price to earnings multiple of 4 and a dividend rate of about 6.7%. We like to see companies that are paying a dividend, right, especially right now. Too many people have been used to seeking just price appreciation without a company that's paying a dividend. Well, we're not in that type of environment anymore, or it's starting to really shift over to more value-oriented companies where their multiples are more in line with where they should be, and they're actually paying out to their shareholders, which, hey, what a concept, right? So we want to start receiving dividends. And I know, a lot of, younger investors like myself, I'm plenty of other people that I've worked with as well. They don't typically seek dividend oriented stocks, but I'll tell you what, now is a really, really good time to have dividend paying stocks. You want companies that are profitable and paying you at just by holding them. All right, so their profitability right off the bat, we see their gross margins are at almost 49% compared to the sector median at 41%. Drop down to the bottom line, their net income margin has about a 24% net income. So that's a really good margin. 24% is a really good margin, especially in this industry. Sector median's only at 7%. So they've got their cash they've got a lot of cash coming in. Now, their balance sheet is something that I would question. If a company's doing so well in terms of their profitability, do they have a decent balance sheet? Well, let's check it out. All right, so right off the bat, their total cash and short-term investments, we're looking at a good amount, and they've kind of been hovering within the same range for a while. So that's good to see. They're probably putting money to work. Their accounts receivable increasing over time. That's good to see. If we start to see a company's receivables increase a lot, that means they're not collecting any money for it. So that would be concerning. But to see that it's increasing a little bit, that it's a good thing. They have current assets of over 30 billion, so that's a plus. Their long-term debt has been going down over time, so that's a plus. Let's jump over the cash flow. I want to see their cash flow from operations. That's the primary factor that I usually look at is cash flow from operations. I want to see literally how much cash are they generating from their operations. And you can see they are crushing it right now. So Petrobras is one of those companies where I feel comfortable putting money to work. Again, strong dividend yield. They've got a consistency paying their dividend for a little time. They have a really strong balance sheet, not look like they're over leveraging. Their net income margin is fantastic. It's really fantastic. That's the first stock for today. Let's move on to the next stock, which is TransGlobe Energy. TransGlobe Energy Corporation is a cash flow focused international oil and gas company whose current activities are concentrated on the Arab Republic of Egypt and Alberta, Canada. They have a proven track record with extensive Middle East and Canadian experience. TransGlobe's focus is principally on offshore oil fields with high individual per well productivity and reserves. All right, so we have another energy company here, guys. Who would have thought? Another energy company, another strong one. Now, this is a little bit different, quite a bit different than the last company I was showing. TransGlobe is a smaller corporation. Their market cap is $325 million. So as you can see, much smaller than the previous company. They're really focused on cash flow, which is, again, something I am really addicted to right now, is finding companies that want to produce more cash flow. If we look at their 1 year performance, they are up about 165%, which is insane. Really insane over a 1 year period. Not something you should be expecting, time and time again. Year to date, they're also doing fantastic, up 41%. So again, much better than what we've been seeing within a lot of growth-oriented stock. Companies that protect you more against inflation, they're usually a little bit more boring than these sexy tech companies, but they produce when the time is needed. Now they have an earnings per share of $1.23, and that's on a $4.37 stock, guys. So that's huge considering their share price. They have a forward multiple of 3.63, really low compared to the industry average right now. And speaking of earnings, let's check out their earnings right now. Let's see how they're doing. So their gross profit margin is 55% compared to sector median at 41%. Their net income margin is 24% compared to sector median of about 7%. So they are knocking it out of the park, about 3 times higher, 3 times as much for their net income margin. So again, this is another cash-rich company. Anytime that they have the sales, they're dropping down to the bottom line, guys. So we have their gross profit margin. Let's drop it down to the bottom line. How much are they taking to the piggy bank? They've got about 24% net income margin. So very, very strong performance right there. That's the type of thing that I like to see. Now, the company isn't currently paying a dividend, but they do have a new distribution plan that they're putting into place. And they have a target minimum distribution of 75% of free cash flow. That's not bad. Something I find pretty exciting about the company as well is their production. Egyptian market, they've got 7 wells currently that they started with in 2019. They have over 100% increase and are now up to 17 wells that should be in production within 2022. So that's, this year, that's a huge increase in production. And that's just within Egypt. Now they also have their Canadian market. And here we go. In approximately 2 years investing within business unit cash flow, the Canadian business is capable of generating $45 to $50 million per year of free cash flow. So remember, if they're having a 75% distribution policy, that would mean 50 cents per share from just their Canadian productions alone. So that's big. So if they have so much promising production ahead within Egypt, and they're currently in development right now, and next they've got their Canadian market, which looks like within again approximately 2 years they're going to have a much higher production there as well. This looks very promising, and seriously, just from Canada alone, that's a huge distribution on a, what was it again, a $4 stock, $4.37 stock. Like that's huge. That's huge. So just keep in mind that this is a smaller cap company. So having some volatility is pretty inherent with smaller cap companies. So just keep that in mind as you guys are investing. Do your due diligence, do a lot of research beforehand. But from what I'm seeing, it's a good company. They've got a lot of upcoming production, a lot of upcoming projects that are right now just in the works. Don't forget to check in next week because we do have another surprise in regards to this company. So stick with us there. So TransGlobe Energy was the second company for today. Let's move on to the third, which, hey, surprise, guys. The third company isn't even a company. It's more the industry in general. And I'm talking about the shipping industry. Genco Shipping and Trading, Zim Integrated Shipping, and StarBulk have been on fire the past year. All of these companies ship products all over the world to every continent, primarily focusing on dry bulk shipping. With pent-up demand due to the pandemic, supply chain issues, and increased oil prices, the shipping industry is presented with a very unique opportunity to have increased profits. So all three of these companies are really, really good companies. Like I have nothing against any of the companies really. They've all been doing fantastic. I'm long on all of them personally. So I really think that they're going to be in a good spot for this next year, especially as prices are increasing, especially as interest rates are going up. Their price return over a 1 year period, we have Genco up about 48%, Zim is up 62, and StarBulk is up 55.5, 56, we'll say. Now, if we look at it over a 1 year period, really they land like really close to, my big head can get out of the way here, really close to the same area. I'll say Zim has had some momentum behind them within a lot of other traders, investors up until recently. They've got really good momentum, I'll say that. But it seems like they're starting to revert back to the mean. If we look at them year to date, all these companies, we've got Genco up 37. Zim is down. I think they're actually up a little bit higher. They're down about 2% after Friday's results, and StarBulk is up about 24%. So as you can see, each of these companies is kind of in line with each other. Year-to-date performance, obviously, there's a really big difference. Zim, again, they had a lot of momentum last year, and it's really started to drop back down this year. My largest holding out of these three is within Genco. I have a higher conviction within their management team. They've got an all-star team that's really put together, and the way that they manage their business is honestly just like a portfolio manager manages risk within their portfolio. The way that they're measuring different things, I really have a lot of respect in terms of how they're doing that. So I'm a little bit more biased towards Genco. But again, I'm long all these companies. All of them are paying a strong dividend, a really strong dividend, especially Zim. Zim is paying a killer dividend. All of them have just killer net income margins. Killer. 33%, 43%, almost 50%. I mean, it's crazy. So great net income margins. That's what we like to see. Now, that's why they can pay out a dividend. All right, let's jump down to their dividend rates. All right, starting with Genco's, they have a dividend yield of 4.5. Zim Integrated Shipping, their yield is 35%, which is insane. So they're paying out pretty much all their earnings, which is awesome. That's great to see. And StarBulk, their yield is 15%, paying out about $4. So as you can see, each of these companies have really strong dividends, really strong dividends. Now, the cool thing is each of these companies, they're in a really unique position because as energy prices go up, then a lot of times they're going to slow down. They're going to turn off their engines on their ships and kind of coast through, so they're not just ripping through oil to get from one place to another. Now, as they do that, their rates, their shipping rates, can also go up at the same time. So that also tends to lead to a higher net income margin for them. So they're in a really good spot when prices of oil are going up. Hey, they have to turn off their ships, coast a little bit, but their rates don't change. Now, some risks that we should all be aware of is, obviously shipping, there's going to be political tensions involved with this as well. So between Russia and Ukraine, so there's a lot of transportation that's happening in that area. So when there's a war breaking out, it might not lend so well to shipping. Also, China is still in lockdown. They're still having their lockdown. So that's going to slow down some transportation back and forth. Now, so there are some other factors to be aware of, but a lot of this, I believe, has already been priced in. I mean, we saw some really big dips within the last month or so when some of the news was coming out about China still going back into lockdown. And obviously the war's been going on with Russia and Ukraine for a while. So that's kind of been built into the price in terms of my opinion. And I'm not worried about buying into this right now either. I've got a really large holding within each of these companies because I feel pretty secure about that. I know they're paying out a dividend, which is all something that we like to see at this point. So those are the three companies that I have suggesting for today. Again, commodities are a really good spot to be a hedge against inflation. I also think the shipping industry is a really good place to be because they're not necessarily affected as much by like material costs, things like that. It's really just the cost of energy to move product from one side of the world to the other. So, and with that, they're also able to make a higher margin. So some pretty good companies, at least to be parking money, even if it's for a period of time. You can see some really good capital appreciation within these companies, as you can see. So I think it's a smart place to be. Inflation's just going through the roof. We can't be sitting with these tech companies or growth stocks the whole time. I know it's counterintuitive because we've all lived, 10 years of investing easily, and tech has been the place to be. We all thought it's never going to go away. Well, guess what? Interest rates were at zero practically for the last decade. So that's why it made things so good. Now that interest rates are going up because of inflation, we need to protect ourselves, protect our portfolios, and make sure that we're staying dynamic and moving with the investment environment and not staying stuck in the mud. All right. So those are my suggestions for today. If you guys have any questions, feel free to reach out. Click the link in the description down below. We can set up a one-on-one consultation, see if any of these stocks make sense for you and your portfolios, or if there's something else that's more appropriate. Don't forget to like, share, and subscribe, guys. Don't forget to check out next week's video. Got a nice surprise there. And I'll catch you guys next week. Take care.